Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Welcome to Cut to the Chase. Today is Thursday, the 25th of July. I'm Daniel Lam, your host for the podcast. Buy on dip. This strategy has, in general, worked quite well for Indian equities over the last 10 years. And this was what we saw once again on the announcement of the Indian budget earlier this week. Investors bought into the intraday correction, pushed the index all the way back to the opening level, with higher than average daily volume. So overall, the budget supports a broad-based growth while sticking to the path of fiscal consolidation. So there were a few key points. First of all, the Indian government maintained fiscal prudence. So it reiterated its commitment to fiscal consolidation path by bringing down fiscal deficit to 4.5% by financial year 2026 and lowering government debt over the medium term. Secondly, they are focusing upon investment-led growth. So for FY 2025, capital expenditure stays at 3.4% of GDP, with high outlay to support infrastructure, railways, housing for all, developing emerging cities, and transition to renewable energy. Thirdly, the taxation reform. So this was modified to benefit low-income individuals, which is what we expected after the latest election outcome. It has also changed to help foreign corporate entities and angel investors. That's pro-business. And finally, increase in social welfare spending. Again, this is done in response to the election outcome. So like we talked about in previous podcasts, the proposed stimulus for the rural economy and agriculture and the lower income individuals is a response to the recent elections and is going to make the growth in India more solid and beneficial for the economy overall over the longer term. This investment-led growth through higher capex outlays is likely to support broad basing of GDP growth momentum over the near term. So we believe this budget supports our overweight stance on Indian equities within the Asia ex-Japan region. Now, in the Indian equities, we are overweight large cap over mid and small caps, given greater margin of safety. And our preference is a barbell approach via overweight on domestic cyclicals, such as industrials and financials, and balance this with an overweight on consumer staples, which is likely to benefit from a boost in agriculture and rural incomes. That is all from me for today. As always, if you enjoy this podcast, please don't forget to rate and like it. Thanks for listening, and we wish you a happy day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.